Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark compares negative Canadian employment figures to positive U.S. stats. Sprott U.S. Holdings Chair Rick Rule's hot tips for gold investment. Real estate consultant Ross Kay tells us BC home prices were already falling before the 15% foreign buyer tax. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always enjoy being with you, Jim.
Wow, what a difference a border makes when it comes to the latest jobs information.
Isn't it something? On the north side of the border, we lose 71,000 jobs, and on the south side of the border, they pick up 287,000. So both numbers catching the traders offside, end up with the U.S. dollar index tacking on a good move here today, up 45 basis points, up 0.5%, and the Canadian dollar down over 1%. We're looking at just under 76 cents on the Canadian dollar. So this now, if we look back to the April high on the Canadian dollar when we were flirting with that 80 cent level, sold off for a month or so, bounced back, but we've had 4 attempts now to rally, and each one of them progressively coming down at lower levels. So still thinking that there's another couple of cents on the downside just as part of the correction process on the Canadian dollar that we did with this decline starting in April. And the line in the sand on the upside, I think, is the 77 cent level that we tested 5 out of probably the last 7 days here. So the pressure's to the downside, and looks for another couple of cents. Now the dollar index on the other side of the equation, with all that strength, has been quite helpful to the U.S. stock market and taken the wind out of the precious metals. And this is coming sort of at a time window that I have been looking at. We've talked about a 26 to 29 week window that's normal on the mining stocks, the precious metal stocks, when they've come out of a bear market low, as far as the length of the initial rallies. And this was the 28th week. I'm starting to see a lot of excesses in terms of some of the big names, the Newmonts, the Barracks, the Rand Gold. The monthly charts are giving signals that as of the end of July, type of things that we don't see that often. Maybe 10 times in 40 years you get this overbought, and in virtually all but 1 or 2 of those instances, the following month sees maybe marginally higher highs but ends up trading down. So kind of hoping that we see that 20 to 25% haircut in these miners in the next couple of months that provides the bottom for the buyers who weren't there at the first part of this year to get an opportunity to pick them up this time around.
I was just going to say, is that how you should look at it? If there's a correction, even a sizable one, that gives you a better opportunity to stock up on precious metals?
Oh, I think so. I mean, if this clearly, when you've declined as much as we have over that 5 years on the miners and on the bullion prices as well. I mean, think of it, $50 silver down to 14 and then coming back into the 20s. Those type of declines, you get an action or reaction type of move. So the extent of this rally is such that it's probably the initial stage of a longer-term move, I'm thinking, that can last 3 to 5 years. And the initial stage of it is usually pretty exciting, just like it was in the stock market, coming off the 2009 low. So the first substantial pullback provides usually one of the best buying opportunities because you know what type of risk you've got. I mean, at worst case, it would be the ones that we saw at the tail end of last year, but I don't think we have to look at that as the max, as the likelihood. It should hold up better than that. Ideally, you look for some short-term oversolds as we move along, but this has been a pretty big run, and it's time for some rotation to happen in terms of the various sectors of the market.
What's your feeling about crude prices going into the fall?
Well, I mean, it is the shoulder season. You would expect as you get past the driving and the hot season before you get into the cold area that prices would stay under pressure. From our perspective, it's 5.5 months since the low was in crude oil. It has corrected down about 22% off that $50 to $52 high. This should be, in our work, a general support area in this high 30s to low 40s. Probably has some difficulty getting through 45 to 46 at this point. But I think of it in terms of a trading range, and still thinking that the gassy stocks, the gas itself, is probably the best play from here through to November, December.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up, Sprott U.S. Holdings Chair Rick Rule on This Week in Money.
Always consult your investment professional before making any investment decision.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Rick Rule, chairman of Sprott U.S. Holdings Incorporated, available online at sprottglobal.com. He joins us from Vancouver. Rick, welcome to This Week in Money.
Thanks for the opportunity to be on your show.
Now, Rick, I have to say to our listeners, first off, you're the most quoted person among all the experts I talk to on a weekly basis. They said, Rick Rule said. And they take it as a rule. So I think it's a big compliment for you.
I don't know if I should take a bow or take the blame, but go ahead.
You just wrapped up the Sprott Natural Resources Symposium in Vancouver. What was the turnout and what was the mood there?
The turnout was great. It was 1,070. It could have been substantially higher except for a fire marshal's permit. It was quite busy. Obviously, the gold investors in the crowd were more than happy. They were ecstatic. The people who were at last year's conference heard rather aggressive buy recommendations with regards to gold, and those who participated last year came into this conference up really, really, really substantially.
Was there any consensus on where the markets are headed?
One of the nice things about our conference is that we try and bring in a range of speakers to avoid consensus. The normal expectation around a gold conference is that the gold price is going higher through good markets and bad markets. But relying on that as a positive indicator is sort of like going into church and asking the choir if they believe in God, you know. I think there was a healthy skepticism from the podium about the junior gold market, the suggestion that it probably, in terms of the junior gold equities, deserves a rest. Markets don't go straight up. Markets need to back and fill. That's normal and natural.
I'm hearing right now that there's kind of a downturn. There's a seasonality to gold, for example. In the summer, it usually goes down a bit going into the fall, and then it picks up again in the spring. Is there any outlook for that?
You're above my pay grade there. I understand that there are alleged to be seasonality factors associated with gold. My own experience with regards to the gold equities is that they've often sold off in summer. I've usually taken the cynical point of view that that's a consequence of the fund managers going to their cottages in August and being out of the market. I don't know whether that's true or not. It's just my cynical side coming out.
What about the big pickup we saw in gold and silver over the past year? Was it expected?
Well, I think two things. Yes, it was expected for two reasons. One, gold was oversold. Remember that you can get dead cat bounces. But a much more important thing, I think, in the gold was the impetus provided by first zero interest rates and then negative interest rates. Remember that for 35 years, one of the strongest correlations in terms of understanding the gold price has been that gold trades inversely to fiat currencies, specifically the world's reserve currency, the U.S. dollar, and more specifically, gold has, with two exceptions, correlated very well with market acceptance of the U.S. 10-year Treasury, the world's benchmark note. In 35 years, or really going back, to 1982, the yield on the U.S. 10-year Treasury has declined from a high of 15.6 to a low of 1.3. That would tell you arithmetically that the U.S. 10-year bull market is much closer to the end than to the beginning. If you look at that in terms of gold trading reciprocally to it, you would suggest that the gold bull market is much closer to the beginning than the end. The truth is that 6 years ago, if a client came to me and said, I want to buy $1 million worth of bullion, I'd say you understand that your avoided yield is 6%. In other words, that bullion's going to cost you $60,000 a year in rent. The rent was significant. Now that rent is $13,000 a year. It's much less significant. So the avoided cost of owning gold is lower, and the attraction of the competing instruments is also lower. No surprise that gold is higher.
When people buy gold bullion, do you think it hasn't been widely publicized that you have to pay a storage fee on it?
Well, of course, from the Sprott point of view, we would encourage people to buy the New York Stock Exchange traded proxy, the Sprott Physical Gold Trust, and not pay the storage fee. And by the way, not pay the buy and sell commissions that dealers choose, but rather pay 25 basis point exchange fee in the New York Stock Exchange. But the truth is that I think that people are buying gold, either certificated gold or physical gold, more as insurance. And if they're holding gold over 10 years as insurance, those fees probably become less expensive in the total mix. I can tell you this, despite the fact that that my life working for Sprott is somewhat hedged to the gold price, what I find personally is that I sleep better owning it than not.
What's a better bet for the average person owning bullion right now or looking at the junior gold miners?
Oh, for the average person, the bullion. The bullion is a savings product, and most people in North America are undersaved. The junior gold stocks are pure rank speculation. Only own the junior gold stocks with money that you can afford to lose half of if you're wrong, and only own them if you're willing to do the work necessary to understand them. We ask our clients, in addition to the work that we do on their behalf, to budget 1 hour per month for every stock they own. So if you own 10 stocks, be prepared to spend 1 hour per month reading quarterly reports, reading proxies, reading annual reports. If you own 20 stocks, which is not uncommon, budget 20 hours. Many, many, many people transfer dormant accounts into us with 50 positions, which should presuppose that the person who owns that account is willing to spend 50 hours a month studying their positions, which almost nobody ever is.
Well, that's almost a full-time job.
Yes, sir.
Why is it that people think that they can just ignore their investments for a long period of time and still be okay?
I think that people who have the money to invest and speculate are aggressive, positive people. And I think what happens, particularly in your market in Vancouver, is that everybody knows somebody who's made $1 million speculating in resources. And they look at themselves and they look at that person and they say, that person isn't any better than me, not taking into account the luck that that person might have, the access to information that person might have, or how hard they were willing to work in order to get that money. By the way, don't take this conversation as saying to your listeners, don't buy junior gold stocks. The truth is that although I encourage investment, all the money that I personally invest, I made speculating. What I'm saying is if you're going to speculate with money that you could afford to lose half of, even when the narrative is attractive like right now, and limit the number of stocks that you speculate in to those that you're willing to spend 1 hour per month per stock studying.
Rick, you had some great guest speakers at the conference. Can you tell us some of the highlights?
Sure. I'm embarrassed to say this year at my own conference, I was my fourth best speaker, which presupposes the three people did substantially better than I did. I think the bull case for gold was made extraordinarily well by Jim Rickards. I'm not sure I have the courage to come to the same conclusion that he did, but he laid out a wonderfully logical, compelling case for much higher gold prices. Certainly Grant Williams, who this was his first time at my conference, did a spectacular job talking about the challenges that the global economy faces. Not saying be out of global stocks, but really talking about the changing demographics of the world, the changing regulatory circumstance, the competitive nature of the world, and also made a very good case for gold as an asset class, an insurance asset class. My favorite speaker at the conference, he's always my favorite speaker at my conference, was Robert Friedland, who is the most successful mining financier of my generation. Robert's blend, his ability to talk about minerals in the global context, really in the big picture context, in the context of the ascent of man, and his description of the process by way of which he has gone about making these enormous metals discoveries, and his ability to convey very complex investment topics to individuals that have a life, that aren't willing to spend as much time on it as he is, was truly unique. So I would suggest that those were my three favorite speakers. My fourth favorite speaker was me, but I've heard myself a lot.
If you were a person today taking a look at their investment portfolio, what do you think they should concentrate on most?
Well, most people that I run into have too much money involved in speculation. I'm with a client here today, and I was telling him that most people with money to invest are aggressive, and so they look at how much money they could make and pay no attention to how much money they might lose. And so I would ask investors to speculate with an amount of money that they could lose half of. Many people don't like the sound of that. I also would encourage investors to balance their portfolios. Most people are over-involved in some sector that is comfortable for them. And the third piece of advice is really esoteric, but it's important that your listeners understand that if they're to become a success in investing. And that is that all markets are volatile and all markets are cyclical. If you prepare yourself psychologically, both volatility and cyclicality are tools. But if you aren't prepared for it, you will become a victim. In particular, with regards to natural resources, because of their incredible cyclicality, you either are a contrarian or you're going to be a victim. Those are your only two choices. That's very difficult. Now, all of us regard ourselves as sort of neutral fact seekers. We think that we search out information around the world and we make informed decisions based on the inputs. But that's not what we do. Our minds are trained to search for information that supports our existing paradigms and preferences. The natural outcome in that process is that our expectation of the future is set by our experience in the immediate, not the long past. When gold is in a bear market, it goes lower because people's expectation is failure. In other words, the trend in motion stays in motion until it ends. Gretzky famously said that he was a great hockey player, not because he was the strongest guy, the fastest skater, the best passer, but because he had a unique ability, rather than to skate where the puck was, because there was all these big mean guys there swinging sticks, rather he skated to where he thought the puck was going to go. His anticipation of the future was not set by his experience in the immediate past. He sort of had some strategic sense of where the puck was going to go. And if Canadian investors would become Gretzkyite investors, that is, understanding that markets are cyclical and volatile, and if they used the information more empirically to determine where the puck was going to go, they would have a much better result than simply skating into the scrum and getting beat up by big guys swinging sticks.
We hear the Sprott Symposium will be back in Vancouver next year. When, where, and is there an early bird discount?
There is an early bird discount, which I urge you to take advantage of because the cover charge on the conference is going to go up substantially next year. Next year, our speakers roster, as a consequence of our success this year, will be substantially better, which means our speaker budget is going to be substantially higher, which means the charge to investors is substantially higher. There is an early bird discount this year. You can get to that probably through a link on your site, but if not, by going to our website, www.sprottglobal.com.
Where and when will it be?
It will be, I believe, I guess it's going to be the third week in July. The attendees have asked that third or fourth week in July, I'm not sure, that's on the website. The attendees who have been coming to ours for 3 years and the Agora conference for the 17 years before have told us that it will be in Vancouver. Given that, we know it will be at the Hotel Vancouver because the service is really good. They have also told us that it will be during the Festival of Lights. Many of our American clients love to come for Fireworks Festival in conjunction with that conference. So that's what will govern it.
The Fireworks Festival is nothing but a gathering of 700,000 of your closest friends.
Right. And my American clients like to be included among your closest friends.
Rick, thank you so much for being on This Week in Money.
Always a pleasure. Thank you for having me.
My guest has been Rick Rule, chairman of Sprott U.S. Holdings Incorporated. His website, sprottglobal.com. Coming up, real estate consultant Ross Kay on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ross Kay from the wealthyhomeowner.ca. He's speaking to us from Burlington, Ontario. He's a real estate consultant. Ross, welcome back to This Week in Money.
Thanks a lot, Jim.
Well, the last time we spoke, the BC government had just brought in a surprise tax, 15% on residential real estate on foreigners buying in Greater Vancouver. What are you hearing about this tax? Does it signal the top of the market? And are sales telling the real story?
Okay, so on the last show, I think I explained to you that the tax came in too late, that your foreign buyers withdrew from the market starting in May, and they had totally evaporated by June. So we got corroborating data from that, was posted by the Bank of Canada here with mortgage policies issued for June closings. So we're 100% sure that is what happened now. Like, we've got corroborating data that we can vet our own intelligence against. So the government came in too late with the tax to have any effect, and as a matter of fact, they did it at the worst time for themselves, because what nobody knows in Vancouver today, I've waited 48 hours in the newspapers to report it, your housing market started to formally correct at the end of July.
Will the 15% tax equate to an immediate 15% drop in prices?
No, the 15% tax will have no bearing on the price drop that is happening. What people in Vancouver don't know is that your prices have already dropped 10% this year. Your peak pricing was reached in February of this year. In February of this year, the average selling price of a house in Vancouver was $1,100,000. It has now dropped $100,000 already. Now, you're going to hear real estate boards and everybody else say, "Oh, well, isn't that a seasonal variable? Isn't that this? Isn't that that? Oh, you're picking the highest selling price in the market." Yeah, I am picking that highest selling price in the market. And in your instance, it happens to coincide with when you hit peak pricing. What that means is that when you had the July sales reported earlier this week, your average selling price actually dropped. Nobody understands that happened. I'm just telling you right now, that is exactly what happened. So there is already a 10% drop in your prices. You've got to remember that those February sales that I'm talking about at $1.1 million, they're going to be in your average selling price for over a year. They're going to be in part of that average selling price for a full 13 months. So the price drop that I'm describing, nobody's even going to know about it until, you're looking at July. You're looking at a full year. You're going to be a full year before people even realize what's really happened out in Vancouver. So the 15% immediate drop in prices, it's irrelevant because you've already had a 10% price drop, and you're going to see further price drops going forward for the rest of the year anyways.
Was this tax then just a political move to look good going into the May election?
No. They made this move believing all of the myth and propaganda that's out there. So for political reasons and the fact that they believed this was happening, they made a political decision. The political decision was to bring the tax in. What I'm saying to you this is, it's going to hurt them because your market has corrected 2 days before the tax even came into place. So everybody is going to, unless my voice becomes the one that people listen to, now, and I will say there is a tremendous amount of press now seeking out how we could tell everybody your market was going negative in August, and as it turned out, it moved 3 weeks earlier than we had forecast. But we were the only people who which is you have in your show records, that we forecasted your market was going negative in August. Everybody laughed at us. Real estate markets move exactly the way that we say that they do. That wasn't going to change. But the BC government clearly didn't listen to us on this issue. They brought a tax in, which they probably should have made part of their platform for the election. But I think they were worried with David Eby out there in the NDP that they better look like they're taking action now instead of as part of an election platform. I think your election, what's May?
Yes.
You go to the polls in May. So what you're going to find is that they're going to be going to the polls basically the months in the last 2 months, so April and May. Although we go to the polls, what week do you go in May, Jim?
We vote May 9th.
Okay, so real estate data for April will have been released on May the 5th out there. So you're going to hear of these massive house price drops just as they're going to the polls. People are going to mistakenly blame that on the tax. They're going to do that because all the realtors now who the government has pointed their fingers at over the last 2 months. In other words, we ended self-regulations, all those nasty realtors doing the shadow flips, not completing their FinTrack forms, everything that I've said on your show, the government now has blamed the housing market on the realtors. What you have seen since this tax was implemented, in other words, they said they were going to implement it, the realtors have pointed the finger now at the government. And they have carefully crafted the message that the house price drops are being threatened because of this move by the Liberal government. Well, the realtors are going to get their wish. Prices are dropping right now. They have already dropped even before the policy came into place. But the biggest drop is going to be seen next spring, just as you're going to the polls. 4 days after the real estate board of Greater Vancouver will have released their data.
The 15% tax now just involves Greater Vancouver. Is there any chance that the markets, say in the Okanagan or Vancouver Island, could be affected by this tax being kind of collateral damage from it?
It's again, the damage was done before. The tax will have no bearing on the fact that British Columbia's housing market corrected in July. Your market right now, Jim. So this is the first radio show in Canada to hear this message. Your market right now is correcting. You've already seen a 10% drop in prices, even though nobody knows it happened. Your sales, for the first time in 37 months, just went negative. That's not a forecast. That is a fact. Your July sales went negative. Once sales go negative, they continue to go negative until a point is reached where they're able to go positive again. In other words, prices drop enough that first-time buyers can start buying again. The problem you have is that as at the end of this trading cycle, the end of that 37 months, in the 35th month, foreign buyers were the most active in your marketplace. So the illusion of house price growth, right, the illusion that a housing bubble is measured by, which is average selling prices, it was at its peak in February, absolute peak in February. The prices have already dropped 10% in Vancouver. I know across British Columbia, right now, you have already lost the illusion of $127 billion in home equity. And I know how crazy that sounds when I'm saying it. It's simply the truth, the fact of the matter. Because province-wide, British Columbia also peaked in February. And nobody seems to understand this. So when I'm pulling up your data here now for British Columbia, and I look back and I see February, your average selling price in February was $780,000 for British Columbia. By the time it gets reported here in July, we're expecting it to be reported somewhere around 690,000. Now, we have our number, but that's our number. We'll let the Canadian Real Estate Association tell you their number first, as we always do. But let's say that it comes in at around 690,000. Okay, 690,000 means that you've lost $80,000, $90,000 in equity from the average home. 90,000 times 1.4 million homes. This is why I've been on your show and warning everybody about what's going on. The devastation of removing $127 billion already this year, from February to July, I can't measure. You're going to have to talk to a super, super highly skilled economist who can understand what this consequence is. But that's the consequence. You guys have lost $90,000 per home in equity, in the house's value. Remember, most houses are financed between 60 to 70% mortgage, 30 to 40% equity. That $80,000 loss came out of the owner's pockets, not the bank.
We'll have more with Ross Kay coming up next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're chatting with Ross Kay, a real estate consultant. How does the real estate bubble in Vancouver today compared to Toronto back in 1990?
Oh, fantastic. That's probably the best. I don't think I've ever been asked that question. I'll explain it to you this way, in simple real estate math. In 1990, the average selling price of a house in Toronto was about $230,000. That's all it was, $230,000. In 2003, on an inflation-adjusted basis, 13 years later, those houses had gone through the price trough, and returned back up to their inflation-adjusted number from 1990. Just inflation, okay? We're talking just inflation here. But that was allowed to happen because it was only a $230,000 house. What I mean by that is that when you only have the average Canadian home, so the average purchase price that you hear announced as the average selling price each month, that usually in Canada carries with it a 72% loan-to-value ratio. In other words, if it's a $100,000 house, $72,000 is mortgage. That's at the average house that is purchased. Canada's been that way for 40 years. And your mortgage data verifies what I'm saying. That being said, the 13 years between 1990 and 2003 allowed the homeowner with a 72% loan-to-value ratio in 1990 to pay down their mortgage for 13 years. So by the time they got to 2003, they were able to go out and buy another house, not because their own house had increased in value, but because they had actually paid down their mortgage. That's how they were allowed to move. Now let's look at Vancouver, where the average price in February was $1,100,000. Let's just say that home prices corrected, not the 10% they already have. Let's just drop it 20%. That is $200,000 of mortgage that needs to be paid off before the person gets back to where they were in February of 2016. And that's assuming prices only drop 20% and they flatline, which we know that's not how a housing bubble pops. Housing bubbles do not pop like that. So what I'm saying is there is no recovery. Those people are going to have to go on 15 years just to eat out that little $200,000 drop in their home's value. Now what happens if it's a more realistic correction between 45 and 50%? Now remember, prices have already dropped 10. So now, these claims of, prices are never going to drop 50%, they're already down 10, you just don't know it. Let's say they drop they drop 40%. They drop the 10 and now they're going to finish off another 40 for a 50% reduction. That means you have to pay off $500,000 of mortgage debt to be able to move in the future. And that's only at break even. That's not even adjusting to inflation. We're talking, for some people, 20 years just to get back to where they were. So this housing bubble is totally different than the one in Toronto because that happened in Toronto in 1990, which of course I worked through. There is no out strategy here. In Toronto, it just simply let 13 years of mortgage payments happen, and that allowed the market to rev up again. Once the market revved up again, that allowed the house prices to increase, and then you had house price increase, plus all that mortgage debt that was paid off, that allowed people to keep moving for the next 10 years. Well, the next 13 years they've done it. But Toronto's reached that point too right now. Toronto turned in July as well. Nobody knows this, but Toronto turned in July. You have my word on it. Toronto Real Estate Board fudges their numbers. They went ahead and backdated the actual sales from last year. They deflated the number. Their geographic area expanded. So if we're comparing apples to apples, the Toronto market is in a correction as well. It just doesn't have to go on. Their correction period will not have to go on as long as Vancouver's is.
How much does a house sale add to the provincial GDP, and if the market slows, could this greatly affect government revenues?
Oh, you got good questions. Okay, so I'm not going to give you the exact number. We have what we have calculated as exact, but I'll give you one that's close enough. My firm, the way that we measure GDP with housing is in the resale market. So I'll let everybody else comment about what the GDP attached to new home construction is adding to the provincial economy. But remember, all buildings under construction are going to be completed. If the foundations are in and the cranes are there, that building will be completed. They're probably already pre-sold. So that GDP will probably remain. It will be 3 to 4 years out where you may see a hit to the GDP because construction there hasn't been enough new projects started to keep those numbers going. in the resale market. On average, every single resale home that sells in Canada generates $91,000 of GDP. 91,000. In British Columbia, where your average selling price is $700,000, that GDP number is substantially higher, and I'm going to estimate. What's that? Yeah, my assistant here it just shouted over. They're working at about $125,000 per home. And that's as you are functioning right now. In other words, you made $149,000 in your house in the last year. That gives you $149,000, or half of that, $75,000, that you can go out and blow if you want. You can go buy a car. You can take a holiday. You can buy a second home. You can do whatever you want. You can blow all that money if you want. So we also look at that being removed. So in your case, we're figuring around $125,000 for each resale home sold. So you take $125,000, 1, 2, 5, 1, 2, 3, and you cut your sales in half. So in other words, your sales in British Columbia are in June were on at $118,000 on an annual basis, but 3 years ago they were at about $68,000. So let's just cut it in half, and instead of $120,000, we'll say that you only have 60,000 sales. So you've lost 6,000 sales a year, and you multiply that by $125,000 in GDP, and you have a $7.5 billion annual decrease in GDP at the provincial level in British Columbia.
Well, as we discussed before, the provincial election is supposed to be held May 9th, 2017. If this legislation brought into an already downtrending market likely to be positive or negative for the current government?
Peak pricing was reached in February. That means peak depreciation is going to be registered next February. So next February, after the housing market correcting for 7 or 8 months, you're going to be comparing a correcting price against a price that hit at the peak of the market. The sitting government will be going to the polls with house price decreases being announced that they can't even imagine.
Of course, this 15% tax is probably going to be blamed, isn't it?
Yep. Unless people accept our research and someone from the government calls us and they say, how did you figure this out? Where are you getting your data from? How are you checking it? And of course, because we check all of ours with the government's own data to be sure what we're saying is correct, because there's enough of a delay that 2 or 3 months later we can check it. So February, March, April. So before the election, someone could actually check our data to prove what we're saying is true or not, that the foreign buyers had left your market in June. So there is proof that there would be a window of opportunity, but I'm certainly not talking to the Liberal government, and I don't think that I would be the friend of theirs anyways, with my commentary in the housing market, but they are going to get the blame, because unless someone can prove what I'm saying to be true, everyone's going to assume this negative situation was caused by bringing in a 15% foreign buyer tax. What I don't like about that is that I think this tax should have been implemented back in 1990, and it should be Canada-wide. And it should actually be a 3-tiered tax. It should be at acquisition, so the time they buy it, they should have to pay 10 to 15%. And then when they go to sell it, any profits that they've made while they've owned it should be 50% tax. Just not on the sale price, but on the profit that they made. And then I also believe that at that moment in time, there should be the option that the government could waive the taxes and apply that discount against the current market value of the property, and the government would have first right of refusal on the purchase of that property. because that would allow the government to say, well, look, we can buy this. This property is now worth $2 million. It's only costing us $1.3 million. At that price, we could put 5 affordable housing units on it. So this makes good all around government policy. Like, it's a good decision for the government to make. So that's my only fear. All the other governments in Canada are probably going to be so scared off because the Liberals are going to get blamed for this. Incorrectly, okay? The foreign buyers have already left before this tax came in. But that's my voice. That's nobody else's.
What's the difference between the benchmark price and the average price?
No difference. The real estate board is going to tell you there's a difference. The benchmark price was created to cover up house price gains. It's very easy for a consumer to say, oh, the average selling price of a house has gone up from $100,000 to $200,000 in the last 3 years. Oh, you real estate agents are making double the commission you used to make. You better give me a deal on the commission because you're doing the exact same work for the exact, actually it's even easier because the market's busier, but you want to charge me twice the commission you would have charged me 3 years ago to sell the exact same house. That's why the benchmark price was created. The benchmark price was created so they didn't talk about price. They wanted to give you a number. They want to say the benchmark price for a detached house in West Vancouver reached 208.2% in July of 2015, whatever they did. The consumer isn't hearing the dollars. If you use a benchmark, the reason to use a benchmark or an HPI is to get away from the price. We don't want to talk about $1 million average selling price. We want to talk about a house price index that went from 190 to 200, because the consumers they're not going to associate 100% commission gain for the sake of the argument on an index. If someone is to take the MLS HPI, the aggregate, they are to plot it against the average selling price, being sure that you are aligning it for the moment in time the benchmark price is supposed to be measuring and the average price is supposed to be measuring, which are 2 different dates, by the way. They're measuring 2 totally different dates, months apart. Then what I'll tell you is they're exactly the same. So the difference is nothing. What the difference is the illusion of what's really going on in the market is hidden from the public. And what's really worrisome in your market, because British Columbia is the only place in Canada where your biggest real estate board does not publish and talk about an average selling price. They only talk about the benchmark. And they don't even talk about the aggregate anymore. They separate it into detached condo townhouses, or detached apartment townhouses. It is really the worst place in the country to be getting housing information right now is British Columbia.
What was the average price for a home in Vancouver at the top of the market, and what is it now?
It was the average purchase price paid. Remember, our firm says this is a buyer side measure. This has got nothing to do with the average house's worth. The average purchase price paid in February was $1,100,000, and it dropped already to July to $1 million. 10% correction.
What was the average price for a BC home at the top of the market, and what is it now?
British Columbia was $779,418 in the month of February, which has dropped consecutively each month, and now is at $694,925.
How much equity has been lost in the BC real estate market since the top of the market?
If everybody in British Columbia had gone out in February and had their homes appraised in February, the end of February, let's say they went the first week in March and had their homes appraised, and then they went out the first week in August and had their homes appraised, you would see a $127 billion loss in home equity. It's why my firm has taken the decisions that we've taken. It is absolutely crazy that people treat their houses the way that they're treating them. And what I mean is that they're listening to real estate board marketing materials, which are designed to benefit realtors, and they're believing that that's really the case. That's not the case. Because you believe that, you just lost $127 billion from February till July. Because you believed it.
Ross, thank you so much for being on This Week in Money.
Thanks a lot.
My guest has been real estate consultant Ross Kay from thewealthyhomeowner.ca. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Rule, and Ross Kay, and thank you for listening. Questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.